Take a look at Bitcoin right now. All you have to do is open social media, and you'll see two completely opposite camps. One side says this is just a small pullback, that global liquidity will return soon, that Bitcoin is about to go parabolic, and anyone who doesn't buy now will regret it. The other side talks about manipulation, about big banks, about death spirals, about debt structures that could drag the entire market down. Everyone has data, everyone has charts, everyone has experts behind them. But what's the result? Most Bitcoin investors still buy at the wrong time and sell at the wrong time. The problem isn't which story you believe. The problem is this: you're trading Bitcoin without knowing what season you're in within the monetary cycle. In my previous videos on this channel, especially video 38, I made one thing very clear. Risk assets don't move based on emotion. They move based on liquidity, interest rates, and big money flows. Bitcoin is no exception. A lot of people tell me, Bitcoin is scarce. The supply is fixed. How could it possibly have cycles? The answer is very simple. Bitcoin can be scarce, but the money buying Bitcoin is not unlimited. And the price of Bitcoin is not decided by small retail investors. It's decided by big money. At this point, I know some people will ask, if Bitcoin is scarce, then in the long run, shouldn't the price just keep going up? That question isn't wrong, but it's missing one very important piece. Let's use a simple real-life example. Imagine a product that's extremely rare, but the people with money are focused on paying down debt, and the people who want to buy can't borrow money. What happens? The product is still rare, but the price can't rise. Bitcoin works the same way. Scarcity only matters when people have money, and they are willing to spend that money. If money in the system is scarce, then no matter how scarce Bitcoin is, the price will still face downward pressure. This is where many investors get confused. They look at supply, but they don't look at the buyer's wallet. And the biggest buyers are not small retail investors. The biggest buyers are financial institutions. That big money comes from investment funds, banks, ETFs, asset managers, and corporations holding Bitcoin at a multi-billion-dollar scale. And behind all of those institutions is monetary policy. Let me make this even simpler, because this is where most people still get lost. People often think markets move because of opinions, because of narratives, because of who sounds more convincing online. But markets don't move because of opinions. They move because of balance sheets. Large institutions don't ask, do I believe in Bitcoin? They ask, what does my funding cost? What is my risk exposure? And where can I deploy capital without damaging my balance sheet? When interest rates are low and liquidity is abundant, risk looks acceptable. Holding volatile assets makes sense. In fact, not holding them becomes the real risk. But when rates rise and liquidity tightens, the logic flips. Survival becomes more important than upside. Capital preservation matters more than belief. That's why Bitcoin doesn't rise or fall randomly. It responds to the same force that drives stocks, real estate, and credit markets, the price of money itself. And that's also why watching price alone will never give you the full picture. Price tells you what already happened. Monetary conditions tell you what pressure is building next. Once you understand that, Bitcoin stops feeling chaotic. It stops feeling manipulated, and it starts behaving like what it really is. A high beta asset moving inside a very predictable monetary cycle. This is what we call winter, the tightening phase, or the deleveraging phase of the cycle. When the Fed raises rates aggressively, holds rates high, drains liquidity, the dollar strengthens, and credit tightens. That's winter. Why is that winter? Because money is expensive. People need cash to service debt, not to speculate. And Bitcoin doesn't generate cash flow, so it's not the asset institutions prioritize holding. Here's the key point. Winter arrives before the price collapse. In 2018, the Fed kept hiking rates. Bitcoin fell from nearly $20,000 to around $3,000. In 2022, the Fed raised rates at the fastest pace in 40 years. Bitcoin fell from $69,000 to around $15,500, not because Bitcoin got worse, but because money turned against risk assets. In winter, the right move is not to buy aggressively or try to catch bottoms. The right move is to hold cash, avoid leverage, and watch macro signals. This is also when the most common retail mistake appears. Price drops sharply and people say, it's cheap now. It can't go any lower. This is the opportunity of a lifetime. But cheap in price does not mean cheap in liquidity. If the Fed is still hiking, if liquidity is still being drained, the selling pressure isn't finished. Bitcoin may look cheap relative to the past, but it can still be expensive relative to current monetary conditions. If you were a large fund paying high interest every month, what would you do? Hold Bitcoin and hope, or sell Bitcoin to reduce risk? The answer is obvious. This is spring, the pause phase when tightening stops and the system begins to stabilize. Then comes the moment when the Fed stops raising rates. No cuts yet, just a pause. Liquidity stops getting worse. The crisis stops spreading. The dollar stops strengthening. That's spring. Buying Bitcoin in spring is uncomfortable. The news is still bad. People are still scared. The media is still focused on risk. You'll ask yourself, am I wrong? Am I too early? But go back to the root cause. Why did Bitcoin fall before? Because money kept getting more expensive. When the Fed stops making money more expensive, even without cutting, the worst pressure is already behind you. Markets don't need things to improve. They only need things to stop getting worse. In early 2019, the Fed paused. Bitcoin based around $3,000 to $4,000 before rising. In early 2023, the Fed slowed and backstopped banks. Bitcoin rose from $16,000 to above $30,000. This is when cycle-aware investors start buying, not because price will surge immediately, but because downside risk has dropped sharply. This is summer, the easing phase, also known as the expansion phase of the cycle. When the Fed begins cutting rates, liquidity truly opens, money becomes cheap, credit expands, and risk appetite returns. That's summer. Bitcoin rises strongly in summer for a simple reason. Cheap money needs somewhere to go, and Bitcoin reacts violently to inflows. In 2020 to 2021, the Fed cut rates to zero and injected massive liquidity. Bitcoin rose from around $10,000 to $69,000. In summer, the right move isn't chasing price or using leverage. The right move is holding positions built earlier and managing risk. This is autumn, the late expansion phase, when the system begins to overheat. Then inflation returns, the Fed stops cutting, or turns hawkish again. That's autumn. Autumn is dangerous because money stops getting cheaper while prices are high, leverage is heavy, and confidence is extreme. All it takes is stalled price action and forced selling begins. In late 2017, the Fed tightened. Bitcoin peaked near $20,000 and collapsed. In late 2021, inflation surged. The Fed pivoted. Bitcoin peaked at $69,000 and entered a deep drawdown. Professional investors sell in autumn not because they can call the exact top, but because the reward no longer justifies the risk. And that's the entire logic. Bitcoin is scarce. Bitcoin is more widely adopted. Banks, ETFs, stablecoins, and U.S. policy can amplify the cycle, but no one can erase the monetary cycle. Bitcoin doesn't reward the strongest belief. It rewards those who read the season correctly and act accordingly. If you want a deeper breakdown of these macro signals, go watch video 38 on this channel. And if you want to keep building a calm, system-based investment mindset, follow Ascend Your Mind. Because in investing, the winners aren't the most active traders. They're the ones who move with the cycle and stay patient long enough to benefit from it.